want to talk now about some of the supply and demand fundamentals that are specific to crude oil. And again, we want to emphasize that these are things, these factors can potentially influence the price of crude oil. And in a lot of ways, it all depends on who the market participants are and how they react. A lot of speculative traders and investors are looking for market signals so that prices move up or down and they can make some money. So we need to keep that in mind, that it's the interpretation of these events and the information that is actually what can influence the pricing. So there are a host of factors that can potentially influence the direction of energy prices. Some are more obvious than others. It's important for anyone engaged in financial energy markets to be aware of these and to research them on a continual basis. Whether you're trading for profit or watching the markets for an opportunity to hedge, understanding the information that impacts energy prices is an extremely valuable tool. It should be noted that while gathering supply and demand data can aid in making a better informed market decision, it does not guarantee success. A recurring theme throughout this course is one of the human factor. We need to keep in mind that all traders are human and react to market news, etc., in an emotional way. After all, they are in the game to make money, and those who act quickly stand to make the most profit. So the results of trader actions set the prices in financial energy markets. Now, when we address technical analysis in a future lesson, you'll see that the charts are really representations of the results of human interaction in the marketplace. We then attempt to determine the probability that the humans, that is the traders and investors, will react in the same way at some future point in time. And this can give us clues to price direction. Now, the following represents several fundamental factors that could influence energy prices for crude and natural gas in the United States. We're going to take crude oil first, and then we'll have a second lesson on natural gas. Many, such as weather and driving mileage, are obvious, but many others are not. And this is certainly not an all-inclusive list. Again, keep in mind, these are factors that could influence energy prices to the extent that those in the marketplace weigh them as important. So for crude oil, the U.S. standard for crude oil is what's called West Texas Intermediate Light Sweet Crude. Okay, light sweet means that there is a low sulfur content with this crude oil. Now, the key market hub for trading crude in the United States is the Cushing Hub in Cushing, Oklahoma. It's a large pipeline and crude oil storage facility. Now, in terms of the different factors, weather. Okay, heating oil is a refined distillate of crude oil. And according to the Energy Information Administration of the Department of Energy, or the EIA, heating oil ranks as the third most important source of residential energy in the nation, with about 7.5% of all households using heating oil as their primary space heating fuel. It's also used to create hot water, especially in the Northeast. It's widely used today in the Northeast as a fuel in boilers that create hot water and radiant heat. In fact, the northeastern part of the United States is the world's largest consumer of heating oil. So as a result, cold weather in this region can be a sign of increased demand for heating oil, that is, crude oil. Since the other regions of the United States do not rely on heating oil to the same extent, if at all, cold weather in those areas is not a factor that influences the price of oil. In addition to weather data such as temperature and wind chill, heating degree days are a good indicator of demand. Now, heating degree days, this is a theoretical measurement. Okay, they represent the amount of energy needed to raise an office building's temperature to a baseline of 65 degrees Fahrenheit when the outside temperature is lower than that. Okay, historical and forecasted heating degree day data can be found on the website for the National Oceanic and Atmospheric Administration, and this link will take you right to that. So, to explain it a little further, if a city, state, or region's heating degree days are above normal, okay, it means more energy was used for heating purposes. Now, the converse is also true. Fewer heating degree days than normal indicates less energy consumption. Now, note, heating degree days can never be negative. All right, at a temperature above 65 degrees, okay, cooling degree days are measured, since it now becomes a question of how much energy it takes to lower the building's temperature to 65 degrees. So, for example, let's say in New York City on a particular day, the outside temperature is 55 degrees. Well, based on the heating degree calculation, it would take 10 heating degree days that day to raise the office temperatures, the building temperatures, to 65 degrees. And so that's how we look at it. Now, conversely, if it were 75 degrees on that particular day in New York City, it would take 10 cooling degree days to bring that building temperature on the inside down to 65 degrees. Okay, another weather event the market keeps a watchful eye out for is the development of hurricanes, which could impact the U.S. Gulf of Mexico's oil and gas drilling and production. Now, according to the EIA, over 23% of the country's offshore oil production and 40% of all of its U.S. oil refining capacity lies in and around the Gulf. Okay, the Gulf Coast of the United States is the world's largest crude oil refining and petrochemical corridor. Now, at a minimum, if a tropical storm enters the Gulf, operators evacuate offshore platforms about 24 hours in advance of the storm. Now, once the storm lands on shore, platforms are remanned, with the entire processing taking about 72 hours at the least. Now, this shuts in a large portion of the oil and gas production coming from the offshore Gulf of Mexico platforms. Now, at the other end of the spectrum, an intense hurricane, if an intense hurricane develops, which can damage or destroy platforms and rigs. Okay, in the case of Hurricane Katrina in 2005, 12 rigs and 30 platforms were damaged, with 18 of those platforms completely destroyed. Hurricane Ivan in 2004 damaged 7 rigs, destroyed 2 rigs and 7 platforms, and damaged 100 miles of underwater pipeline. Now, one of the ironies of hurricanes in the Gulf is that once onshore, they bring rain and cooler temperatures, which then lowers energy demand immediately. And the swath of the tropical system can be wide and far-reaching, impacting onshore U.S. weather for days. Now, the official hurricane season begins on June 1st of each year and ends on November 30th, with the peak time usually occurring around September 11th. Now, during this time, the Weather Channel provides their tropical update at 50 minutes past every hour, which is a critical report for energy traders. If you're ever in a large trading room, a large energy trading room, you will see that among the other information they have up on TV screens, they will definitely have the Weather Channel. The U.S. economy. Energy runs the economy, so economic factors of all kinds are an indication of energy consumption or the prospect of consumption. And given that crude oil is a global commodity, both U.S. domestic and international economic conditions can have an impact on pricing. Okay, in the U.S., the most obvious and frequently reported indication of economic health is the stock market. The Dow Jones Industrial Index, the S&P 500, and NASDAQ results are a daily assessment of the economy from the perspective of investors, both foreign and domestic. Now, gains in the stock market imply future economic growth, which in turn translates into increased future energy usage. So again, this is that perception. A healthy economy implies there will be an increase or at least a healthy demand for energy going forward. Now, in addition, there are weekly, monthly, and quarterly economic reports that can have an immediate impact on price perception as well. Now, here are some, but certainly not all of them. Okay, every Friday, the U.S. Department of Labor Statistics releases their unemployment report. The Institute for Supply Management Index comes out monthly. The Consumer Price Index, which is a measure of inflation, that comes out monthly. The United States Gross Domestic Product, or GDP, okay, that's the U.S. Bureau of Economic Analysis, that comes out quarterly. The U.S. Department of Commerce's Economic Statistics Administration has a vast number of economic indicators, including data from the U.S. Census Bureau and the U.S. Bureau of Economic Analysis. Okay, now, the following data can come from these two organizations: construction spending, housing starts, housing sales, U.S. international trade balances, monthly wholesale trade, manufacturing and trade, sales for retail and food services, personal income, personal spending. Okay, now, any one of these as an indication of the economy, if it's up, it's going to imply that either A, there has been greater energy used, okay, if this is a sort of a look back or trailing index, or it's the prospect of more energy being used in the future. And then another major source of information about the health of the U.S. economy are the quarterly reports that come in from the U.S. companies. Okay, we're always in tune with the earnings reports and earning report seasons, which come out every quarter. And so the health of the various companies especially the larger ones or industry segments, are going to be very, very key to the future use of energy. Okay, then the international economy, especially where crude's concerned. Okay, inasmuch as we now recognize crude oil as a globally traded commodity, world economic conditions can influence prices in a similar fashion as that of the U.S. domestic economy. Certain countries and regions can have a greater influence on oil pricing than others. As such, their economic activity becomes a critical barometer of crude oil demand. Okay, when trading starts each morning on the exchanges in New York, Asian markets have already closed and European markets are at midday or early afternoon. So signs of how markets here will potentially trade are already known. These include equities, currencies, and energy futures. Now, perhaps the most watched nation these days outside the U.S. is China. As of the end of 2013, China's GDP represented approximately 15% of the world's economy, having grown about 500% since 2005 alone. And you can see this demonstrated in Figure 3. Now, as of this writing, China ranks as the world's second largest oil consumer behind the United States and the world's largest energy consumer in general, effective in 2010. Okay, the EIA predicts China will surpass the United States as the world's largest net importer of oil by the end of 2014. So using the same mindset as regards the U.S. economy, oil prices can fluctuate with the changes in China's economy. Now, coming in behind China in crude oil consumption is Japan, whose Fukushima nuclear disaster in 2011 shifted its energy mix to a higher degree of fossil fuels, making them the second largest importer of all fossil fuels in 2013. Now, Japan's GDP has also risen steadily since 2008, okay, as illustrated in Figure 4. Another country with an emerging economy in 2008 was with India, who along with China was given partial credit for the run in crude oil prices due to its increase in manufacturing and exports. The country's GDP took a big leap in 2008 and continued higher until 2012, where it has remained fairly stable since then. Okay, in 2013, India ranked 4th in the world in oil consumption behind only the U.S., China, and Japan. Okay, and you can see the figure here demonstrating India's growth in GDP. In 2013, Europe imported about 22% of the world's crude oil. Now, the Eurozone, which is comprised of 17 continental European countries plus Ireland, has struggled economically in recent years, largely due to the financial problems of Portugal, Ireland, Greece, and Spain. Okay, these are not so politely referred to as the pigs. When bankruptcy looms for any of these countries or bailout plans are proposed, oil prices ebb and flow. Now, at the time of this particular lecture, the European Central Bank is trying to still provide some assistance to Greece before they go into default. The United Kingdom is the largest oil producer in the European Union, yet they became a net importer of oil in 2013, where oil represents 37% of all energy consumed in the UK. Now, a lot of that has to do with the fact that the North Sea production has continued to decline over the last few decades, and so the United Kingdom now has to import the offset in oil. Currencies. Crude oil in the global market is traded in U.S. dollars, so fluctuations in this currency can influence oil price direction. Portion of these new investors that I've talked about in crude oil futures in 2008 were foreign investors. As their native currency fluctuates in relation to the U.S. dollar, their buying power shifts. For example, an investor in the UK can buy more crude oil futures contracts than a U.S. investor when the British pound sterling has a higher value than the U.S. dollar. This influx of foreign capital tends to raise the price of crude oil. Now, conversely, during periods of a strong U.S. dollar, foreign investors tend to sell off oil futures contracts and invest in other instruments. This can lead to lower prices. In fact, while it doesn't occur 100% of the time, there is a strong yet inverse correlation between the price of crude and the U.S. dollar. And you can see Figure 5 illustrates the relationship between crude oil and the value of the U.S. dollar when compared to the British pound sterling. So as an example, okay, if U.S. crude oil was priced at $90, right, a U.S. investor can buy 1,000 barrels of crude oil for $90,000 U.S. Now, the UK investor, all right, if the British pound sterling is worth $1.60, all right, for every pound is $1.60 US. Well, the US investor can actually buy 1,600 barrels with that same 90,000 US dollars. Okay, geopolitical events. I think this is probably a very, very obvious one to us after weather. Perhaps the most far-reaching impact on global energy prices is that caused by geopolitical conflicts. Oftentimes, these can have an immediate and dramatic effect on prices. Again, there doesn't have to be an actual supply disruption, just the perception of one for traders to react in the marketplace. And then generally, once the smoke clears and the facts are known, the market tends to settle down and return to its previous price trend. Unfortunately, world history illustrates there will always be countries battling over something, whether it's land or natural resources. Each situation has to be weighed on its ability to interrupt the production and the delivery of crude oil out of the region. As of this writing, there are several conflicts being watched by oil markets. Okay, the ongoing conflict between Israel and the Hamas on the Gaza Strip. Despite the fact that neither is a producer of oil, this ongoing territorial battle emphasizes continuing tensions in the Middle East, an area of significant oil production. Okay, in Nigeria, there's a group called MEND, the Movement for the Emancipation of the Niger Delta. Okay, they've destroyed oil infrastructure on a regular basis, such as pipelines and loading terminals of Royal Dutch Shell's Nigerian operations. Russia and the Ukraine. Russia and the Ukraine are currently at odds as Russia pretends to be protecting the Russian separatists in the Ukraine and has gone so far as to re-annex the Crimean region from the Ukraine. While the Ukrainian government battles the separatists, Russia has lined up troops along its border. Since Russia is the world's third largest producer of crude oil, and since they're a major supplier of natural gas to Europe, this situation touches on several issues regarding global energy supplies. In fact, a major natural gas pipeline which moves gas from Russia to Europe runs through the Ukraine. ISIS, the so-called Islamic State of Iraq and Syria, is a radical Muslim terrorist group that has invaded parts of both Iran and Syria, overtaking towns and slaughtering their inhabitants. These religious extremists have gained control over producing oil fields and refineries, raising concerns about supplies of crude and refined products in the region. If their advance is not stopped, their control over oil-related assets could continue and change the markets for these products. South Sudan. In 2011, a referendum in Sudan led to the establishment of this separate country, which now controls the majority of oil production and reserves from the previously unified region. But civil unrest, mostly along tribal lines, has interrupted production and brought uncertainty to the country's future. And then what I like to call oil politics. In mid-June of 2014, West Texas Intermediate crude oil in the U.S. was trading about $107 a barrel. By the end of the year, it was down to half that price at about $54 a barrel. Two main factors were blamed for the plummeting prices. One, the increased supplies of oil in North America, coming from the once non-conventional sources such as shale and tight sands, were outpacing demand. And two, Saudi Arabia, fearful of losing their position as the world's leading oil supplier due to the increasing North American oil production, flooded the market with cheap crude in an effort to maintain their market share. This would have a severe economic impact on oil revenue-dependent countries such as Russia, Nigeria, Venezuela, and others. In the U.S., many E&P companies cut back on exploration and drilling or halted activity altogether. And these are but a few of the geopolitical situations which can and do influence crude prices. Supply and demand statistics, any information concerning oil production and or consumption of its distillate products is basic supply-demand information that lies at the core of the market in the end. A huge variety of sources exist for this data, which is usually published on a regular basis. Some of these sources are entities such as governmental organizations, both U.S. and international, as well as industry associations and groups. The crude oil and petroleum distillates inventory. Each week, the EIA issues a report on the status of the country's inventory of crude oil and its various distillates. The report is issued at 9:30 a.m. Eastern U.S. time on Wednesdays and encompasses all reported activity as of the prior Friday. Several pieces of key supply and demand statistics are included in this report, and energy commodity traders are focused on the release of this information as it can have an immediate impact on price direction. Key components of the report are, number one, refinery utilization. Now, this is the percentage of total U.S. refinery capacity that is actually running. Okay, it indicates both demand for crude as well as the production of gasoline. So the higher the utilization, the higher the demand for crude oil at the refineries, and at least it's implied, the higher the production of gasoline. Imports, both raw crude oil and refined products such as gasoline are imported, and volumes are compared to the year ago, which indicates an improving or worsening balance. Commercial crude inventories. The change in inventory from one week to the next has a profound impact on oil prices from a pure trading standpoint. Analysts provide forecasts for the change in inventory ahead of the actual report. Financial energy commodity traders react to the difference between forecasted and actual. And this reaction occurs instantaneously as savvy traders have been glued to the EIA website awaiting the report. Gasoline inventories. Total gasoline products, as well as a breakdown between what are known as finished gasoline and the blending products, gives a picture of supply and demand for gasoline. A decrease in total products could mean more demand for refinery feedstocks. A surplus could mean just the opposite. Now, to further interpret this data, it needs to be understood that blending components are merely that 10 to 15% of additives to unleaded that arrive at the 90, 10, and 85 blends that we see at the retail pump, the so-called finished gasoline. Distillate fuels. This category is primarily comprised of heating oil, and as indicated above, cold weather translates into an increased use of heating oil in the Northeast U.S. Okay? Thus, the amount of distillate fuel in storage during the winter months becomes a critical factor. So these are quite a few, but again, as I mentioned, not all the potential factors that could influence the price of crude oil either from an actual supply and demand standpoint or the perception of such.